Hey, what's up, everybody? Okay, hit record. We are live. Taking a look at the markets right now. I put out a hint of bearishness on this week's email, talking about a potential market top with a risk event, about an 80% chance of a risk event happening. And the thing about it is the happening of it is the challenging part. When is the challenging part. And it doesn't work for all asset classes. This is specifically to equities. So if you are a more focused on currencies or commodities or rates or crypto or something, the same method doesn't work. And as we were talking about last week, it's due to the incentives of the underlying assets. Okay. But equities specifically, it works fantastically for. So I'm really digging this corn move. There was a big consolidation in this general area here. I think we had a couple of people that were looking to take the short route on corn. I think everybody pretty much was looking for a short move on corn. I just didn't see it personally. I was expecting, let's see, 522 down to 299, 522, so would be 840 for a measured move target up to here, which coincidentally our measured move target is right about last swing high on corn. So a measured move target up to here, and we are off to the races. Also, one thing I want to point out about commodities here that that if you're just taking the information you have from equity indices and try to apply them to all asset classes. And also, this is something that people they think that they can get a chart pattern or a gaggle of indicators and it'll work on every single market out there. And that's not true. So, and this is why understanding the incentives first, and this is why understanding incentives of the underlying asset class and what is happening there, what could happen and why it could happen, I guess is a better way of saying it. If you understand that, then you understand that the parabolic blow off and whatever 10% up move and all that sort of stuff that works so well in currencies. I'm sorry, in equities, equity indices. It doesn't work in commodities. It doesn't work in currencies. It doesn't work in crypto. It's different. And that's because the incentives are different. It's because the structure of the products are different. The global economy, the way things work is completely different in each different one. So it's important to understand what game you're playing. And that's why we can have 4 or 5 straight months of, look, this thing, by the time it entered bull quiet, it went from 420, let's call it, to 680. We're already up to 680. So 160 points, 260 points higher. I mean, we're talking like, what is that? That's about, over 50% in a couple of months, and it's still going. There's not a lot of reasons to see the ags not perform like this. So that's different than equity indices. So with equity indices, things trade differently. The incentives are different. It's more of a, there's a limited supply of corn. There's a limited supply of Bitcoin. There's those are two interesting features where you see corn trading the way Bitcoin trades. because they're very similar. Now, not all cryptos, each individual crypto has its own mechanism as well. You have certain tokens that are inflationary, they're deflationary, they have different tools. Oh, I can't hear. Andy, you're muted, buddy. Apparently you just don't need to DM me. Ruins the thing. Get my headphones connected. Okay. All right, headphones are connected now. Apparently Andy was having a conversation or something. I didn't hear it, but good on you, everybody. Okay, so let's get to some of the things that I'm looking at here, and let's just go with ES. Okay, so we can see that we've dipped into bull quiet, and each time we've dipped into bull quiet on the S&P, it's dipped right back out of it. So, okay, that's interesting. Let's throw our pivots on there. We're above the R3 on the pivot, and then let's take the pivots off so it's standardized again. And then I'll just have a look at our trend line indicator. That's generally where it is. And yeah, we're a little bit above it. So let's start looking at intra. What I want to see is the size of the daily moves. And you can see these moves are above, they're not above 1% really. It doesn't look like anything's above 1%. You got one down in here when it broke it out to all new all-time highs is when we got that big bust, because the thing is, there's so many shorts sitting right here, right? This is where the shorts live. They're always going to be shorting this, thinking, this is a double top or a head and shoulders or whatever pattern it is. And so they're going to be shorting here and have to cover here. And that's why you get such a big bar here. Most of these big bars in an uptrend are actually short covering bars, where longs are doing their normal buying thing, but the bears are getting stopped out. And so they're going to constantly be doing the buy to cover, buy to cover, buy to cover. And so that's what we had here. Now, this would be a micro bull volatile, bull quiet, in a longer term bull quiet. And maybe we want to take a look at the weekly to see how more parabolic it is. And that to me is you can see it a little bit there. You can see that break off, but we've consolidated. So we're sitting there consolidated. Let's have a look at Dow, which is the one I went into. And same, we've gone now. We could say we went parabolic here, but we never really got above R3, so it's not very convincing. So maybe we're more like this. And here we go. So maybe we're more like it. There's a whole lot of the interesting things. There's a whole lot of consolidation going on in this area right here. So what's nice about it now we're definitely in bull volatile on the Dow. Now we have two things happening here. For any of you Maverick traders, you should recognize this setup. All right, yeah, hold on. Give me 1 minute, guys. I'm gonna take a quick break. I gotta chat with my wife. apologies. It's my son's 1 year, 1 year birthday. Tomorrow. He's 1 year old tomorrow. And we actually have a party happening this weekend, virtual and real life. My wife is over the moon that we've been able to do that, because last year, as we were planning our housewarming and baby shower, I guess, whatever the term was, we had to go into lockdown, and she was badass at that, being an extreme extrovert, and I'm totally content being in, kind of a stay-at-home, chill, not meet people, go and hike the hills sort of guy. So when she got vaccinated, when her friends are cool with either vax, non-vax exposure, whatever, so she showed up. And so anyway, the story being, whole point being, is we are the whole point being is we are having a party this weekend for her friends. So it's a few coordination things we need to get done. My apologies. Back to business. Okay, R3. Okay, so Paul, study pivots. You can go out and look at pivots. Pivots are basically it takes the range of a certain period of time and then adds, kind of finds the average there, and then does, I guess it's standard deviations, depends on the type of pivot you're using. On each, there's a handful of different type of pivots. Just understand that usually 2 standard deviations away from a price mean, like we use in Bollinger Bands, is an extended level. 3 standard deviations is an extreme level. So when we get above the R3 or below the R3 on the monthly pivot for an what do you call it? The equity indices, we tend to find ourselves in extreme territory, and that's going to provide extreme results. So what we can see, I tried to show this yesterday. Where am I here? As we can see in the Russell got above R3 at the beginning of November, and it moved into bull vol at the beginning of November. That was about $1,700. Just because it was above R3 didn't stop it. See, we moved into R3 on the middle of the month, and it, probably if there's an R4, I don't know if I have R4 set up, but it even went there. And then it just kept going, and it kept going, and it kept going. So just the fact that it is in bull volatile, that it is above R3, doesn't mean that it is a market top. It's just the likelihood that there is one is there. And I recall I shorted, it was in November. I remember shorting. Actually, it was probably at the beginning. Ashley did it with me, so she might remember the date. Somewhere in here, we got short once we got into bull volatile, had our blow off above R3. It was a no-brainer. This basically met all the conditions. We had our parabolic blow off. Pretty much a parabolic move. Hold on. Geez. Windy here these days. So we had a parabolic blow off move. We were above R3. We were in bull volatile. All the things were set up for this to be a really good short. And it didn't, and it ran. And so what you do in these scenarios, this is why we have, a system. That's why we use position sizing, and, we're wrong. Sometimes. So what I was looking at before I closed things up, or went and talked to my wife there, we closed above R3, went parabolic, we're in bull volatile, we had a high base setup. Okay, so everything was pointing to good opportunity to get short. Well, I got stopped out here, and that's the reason. That's how you trade, right? You just take your losses if you're wrong. And it went from like 1865 all the way up to 2300 before peaking. So it put in a massive move. And that's because everybody was getting bared up around here, or they didn't really, think too, small caps weren't really interesting, right? I know some of you were asking about it, and I didn't, I was going the other way. I was like, hey, yeah, I don't think it's happened. And, I missed it. So, good on you for those who caught it. And that's fine, like you just want to be right a big amount of time and for big amounts when you can, not every time. So it's a very similar scenario we're at right now. And let's go back to the Dow on this one. So what I was getting at earlier before the break was we are in a high base, kind of parabolic, but have held it. And this setup is either a high base or a power reversal. So a high base would be buy the breakout above it, and I have a buy stop in place. And a power reversal would bring us down 8% or more. And so it's a very good inflection point. A lot of people are going to be, there's whatever's going to happen here is going to be a violent move. Violent move up. Sorry, violent move up, violent move down. I'm blowing my nose real quick. Apologies. Okay. So we have the same sort of setup right here. Have a look at Nasdaq. I mean, everything looks the same. We're all positioned the same here. Nasdaq's done a little bit better, had a much better correction. Whereas, Dow had much less of a correction. That's why I got pulled into the Dow. Across the board, we could definitely see this coming to the market in the next little while. Now, one other thing that I was looking at that is absolutely not relevant, but will be part of my bear porn. So don't get too worried if you see it, thinking that the world has to end now because witchcraft. There's an analog that my friend Seth Golden over at Phenom Group shared in his weekly letter. And let's see if I can find it. There we go. Okay, doesn't want to grow. Hoping you can see it. So this is an analog of the S&P 500 from 2009 to 2010. This would have been the March 2009 low for S&P after the global financial crisis. And then this one is the, I think the colors are different. I can't see the difference, but if I was doing this chart, it should be blue and like two contrasting colors, not two of the same colors, because maybe they're contrasting to you, but they are not to me. It's the exact color. So right here, you can see this. He's basically showing the 2009 bottom and the COVID bottom, and the analog recovery of that. And what's interesting, and it didn't matter to me when I first saw this. I was just like, whatever, this is fine. This is bear porn. And that's whatever. But what actually did stand out to me was the flash crash happened right here. And that actually I traded flash crash. So let's see if I have it here. So let's go. Where is it? So I decided to throw that up on my chart too. Let me pull the other in. And what I see there, that's right. What I see there is very similar to what I see right now. That off. And now I've traded this. I was short this thing. I actually got short. This was flash crash, so that would have been May 6th. I remember, if you guys want to do story time, I think I've already talked about it before, but story time. So I was living in Colombia. I was trading a mean reversion algo on TradeStation. Basically, it would buy it would short a lot of the 1, 2, 3, 4, 5, 6, 7, and then exit at mean. So if you're looking at it, it would be like short, it would like up to 8 shorts, I think, something like that. So short. So I'm short a number of contracts, and then so average price short here, average here, average here. So I'm average short here by the time it dips. Okay, and then I usually get out at like a midline sort of scenario, so where it hits. And then it started shorting again, boom, boom, boom. So it's a counter trend mean reversion was the strategy. And it worked good in the 2000s because it was a sideways market pretty much. I mean, yes, there were up and down times, but it wasn't just straight up. It was multi-directional in the 2000s. So it worked a little bit better in that environment. And so same short, boom, down. I got short here, so I didn't have a chance to get multiple shorts. So it was probably like 5 or 6 shorts, 1 or 2 shorts, exit, and then short 1. And then, so the minimum it needed was like 3 entries to get short or something, maybe 2, or to exit at midline. So I got in here and it starts going down. And I'm like, okay, this is great. This is wonderful. I'm not getting the easy pullback. I'm actually getting a nice prolonged one. So by the time I start looking down in here, I'm like, okay, yeah, we're probably at that, good area. I'm gonna, start expecting to get, to get pulled out. Now this was an algo. It wasn't. I coded the algo, but it was an algo, so I wasn't intervening. I was just kind of monitoring it throughout the day. And then all of a sudden, so at this time I was also playing blackjack, counting cards, living in Medellin, Colombia. And believe it or not, before my wife, I had a girlfriend. And so every day we would go have lunch. Because Colombia is a different time zone where in California, lunch pretty much has to be after 1 o'clock here, or, well, whatever. Like the market closes at 1 o'clock on the Pacific time zone, and so I go. This day starts. It's particularly ugly that day. Just start selling a good amount, down pretty good, and I was expecting the algo to pull me out anytime. I go to lunch and I have a BlackBerry with data. So I check in on my account from time to time. And it's a 5-minute process to get connected to the market and all that sort of stuff. And I log in and I see what's going on, and it's down like, I don't know, 8%, 10%. I was like, whoa, what's happening? Now, again, I didn't really have, everything was on a server on TradeStation in Chicago, but I was in Colombia, and now I'm a 30-minute cab, 20-minute cab ride back to my house and everything. And so I finished. We go early, like I pay the check, we get the taxi We wait for the taxi to come up the hill to gets us, takes me back home. I basically made her, usually I would drop her off at work and I would go home, but I basically said, nope, you're taking the taxi. I got to go home. So I get home and time had frozen. The data that was coming through on my software, because it was the flash crash happened, like I wasn't seeing, I like it was still down here. Well, it was already down here, or by the time it got down here on my screen, it was already back up to here. So I could turn on CNBC and see real time, or I could go to this other thing and get real time. But my trading software, the bottleneck was so big, the pipe was so jam-packed full that the data couldn't get through. There was massive latency. And, I'm next to the exchange. So, everybody was having issues with this. They were talking about it on CNBC, Bloomberg. Everybody was just saying, oh, this is unprecedented. We've never seen, nobody knew what happened. There were people that bought, they threw out like garbage bids on like a stock trading at like, I don't know, $70. They put $1 in there and they got filled. We've seen this in crypto a number of times, but this shook the entire stock market. And it happened like, yeah, there was some weakness. You could see there was some weakness. And yeah, look, man, we'd rallied from, this was the dot-com lows. Actually, no, not dot-com lows. This was the global financial crisis lows. And you just look at that, And then this right here looks a lot like what we had in February, right? That pullback and then continued off to the highs. So the analog looks very similar. And we could be here on the analog, or we could be here if the analog is even useful. But I saw it and I was like, okay, this was an event that wasn't priced into the market. This was something that happened that, like, no, come on, how would you have been able to anticipate a flash crash? Like, nobody had seen a flash crash. When it happened, there were people who were just like, if they had access to an exchange where they could actually enter trades, they were throwing garbage bids in and getting filled. But for the most part, your average trader, you didn't have, the internet wasn't good enough for it. So I'm not suggesting a flash crash, but what I am suggesting is this is interesting. This is what interesting looked like. And then I get back to my valuation chart. And every time we've been up this high on the Russell, we've had a market fall apart. Lehman, this would have been Lehman right here. I think this would have been, move out of the way. That might have been Bear. I don't know how, I can't remember how long before Bear was. Now let's see where Flash Crash was. This was Flash Crash. So a long way lower was Flash Crash. So this one doesn't really map it. This would have been the US debt downgrade, I believe. This would have been Chinese commodity crisis. This would have been, this was for meltdown. And then COVID was even lower than where we are right now. So, okay, I've got two pieces of bear porn. I've got two pieces of bear porn out there that, give it a little bit of, they give us a little bit of indication that maybe we have a reason to look. I'm not saying that the small caps are the key to the industry, and when small caps are key to the entire US economy, and when, small cap index is overvalued compared to the amount of money in circulation. That means that small caps have increased in value to a point that historic levels, we've been this high twice. One was the dot-com bubble, and the other one was the Q4 meltdown. We're currently above global financial crisis, long-term capital management, flash crash, US debt down, giant China blow, all these things, right? So we're like 9/11 was right here. Even let's throw that on the thing because that turned the markets off for a week or so. So there's a certain level where it gets a little bit fragile. And look, this is just witchcraft. It's nothing fancy. Like this isn't a quantitative, in my mind, it's not a quantitative model. It just so happens that every time we get above a certain level in small caps, that things get antsy. So let's have a look at, what it looks like with the S&P. And so let's put the same ones up there. That's long-term capital management. This is .com. So this would have been 9/11 right in here. So remember, what we're measuring as the denominator is M2 money supply. How much dollar bills are actually there? If you have $200,000 and you used to have $100,000, then you can buy things. Now, if everybody suddenly has $200,000 and you had $100,000 before, well, everybody's going to be bidding up the price. So price to earnings is a poor measure of value because you're not taking into account the inflation, and you're not taking into account how quickly the amount of dollar bills floating around out there is being things. So when you hear somebody talking about price to earning ratio, and understand that if you're comparing price to earnings and earnings are up or the price is up, it's because the amount of dollars supplied in the market, there's just more. So if you have more, that you just keep buying. This would have been January 20th. So this one's COVID. You can see that it was COVID was more offensive. So what I'm getting at here is on this level, on the S&P 500 big caps, it's not nearly as bubbly as the dot-com bubble. So this is one thing that's kept me from being extremely too worried about prices being expensive or overvalued, because historically speaking, even into the early 90s or to the late 90s, we're still below those levels. And this could be the floor. As we break out of an area, what was resistance becomes support. And we may actually very well be blasting off. And I think we do. I think we will blast off to an entirely new era in markets. So we start to see it here. Let's take a look at IXIC. Is that Nasdaq? Yeah. I wonder how far it goes back. Okay, good. 1981. So now for the Nasdaq, obviously, the Nasdaq being so heavy technology, it basically went the highest, right? And it didn't really participate in asset prices through the global financial crisis. That was more in typical, everybody was making money in more financials. They weren't really focusing on tech. You can really see how little, how little it was affected, in all these other times. And then we get to Q4 2018. This one's COVID. So one other time in history have we ever been this high, and that was the dot-com bubble. Of course, that was the bottom of the first sell-off in the dot-com bubble back in 2000, March, April, May. Yeah, that was the first sell-off. But we're higher than COVID. Everything else we're higher than right now. So I'm throwing all this out there because what we're seeing is potential. This is where we are risky, right? This is all risky. And if we look at the analog, I can see where the, where was it? There's the analog, basically. It looks fairly similar. Dates are even lined up almost. This bottom was February 5th. This bottom was January 31st. So pretty close, pretty close. And so we find ourselves like right here, potentially. This is what it looks like. We could have, you know, it doesn't have to trade, you know, day for day or anything like that. But what happened was fragility stepped in and affected the market. So what I'm suggesting is now we have R3, we're above R3, we're in bull volatile, and we've gone fairly parabolic. So something usually comes in and gives us an 8% or greater correction, and then fixes itself and, you know, goes along its way. I'm considering, and I'm believing that we're going to get into a bit of, if this thing happens, one of the scenarios I'm thinking is that we do this, whatever, down. It doesn't have to be a flash crash. It can just be an 8% move. So if we're at 8, that takes us eventually down to about right here. Okay. So back to February, March, April price area. And, you know, so that also means that that's just 8%. Actually, is that right? 5. Yeah. That's just an 8% move right there. So that's not too far. Now, if it is a flash crash, it did go 15. Yeah, that was a 15% sell-off. So, which brings it down to about here, which would have been basically the December, the end of December, I guess, or whatever, December, the end of the year. You know, and then who knows what happens? Is it, you know, is it something like what's happening in India right now that causes this? Is it a technical glitch? Is it a hack, a cyber attack? Who knows what it is, if it even happens? But I'm just saying that the risk of something, if this is the analog, if the analog actually works, then if the analog is actually going to play out, then we have a potential, you know, really quick move down. And by the way, that's not different than we've had for the last, this is our current one. Like that's happened just since COVID. We had there was one, here was one, here was one. Like it's happened, was that 6, 7 times in the last year? So relatively speaking, if you wonder why you're not able to, you know, hold on for dear life, hodl through all these things, it's because it's very volatile. You know, an 8% or more sell-off, the time people start buying is when it looks the best, and it always looks the best at the very top. It never looks good down here, right? So if we're always buying the top, we're always thinking that we're buying the top, so I'm going to wait for a pullback, and then you miss the pullbacks. It's because our timing is off, right? We want to adjust our timing. Look at comments here. Okay, sorry. Why are you choosing the Russell? Why not bond or Nasdaq, et cetera? Is there a significance for you? So yeah, I don't know if I answered it. That's yeah. I think Dan did pretty good there. I don't know. I don't know why the Russell is more accurate at predicting that. We can certainly let's take a look at. I don't know if this will do it, but let's take a look at bonds. It doesn't. I don't see anything here that tells me. Maybe UST. Let me find an index. Okay. Yep. Okay. So sorry, I didn't read your answer. Thanks, Neely. If anybody knows a, I don't know the, I don't know the bond. I don't know the bond, if there's an index for a tracking index for bonds that would, well, I want to go back before 1999. So if you guys can find a ticker that'll go back further than 1999, then I'll throw that one in there. 10-year plus 5-year plus 2-year. That's the symbol. Oh, no, it's not. That's what I'm saying. Not ideas. I want the symbol. And I don't want the underlying. I don't like the. I don't like the. I don't want to do the underlying interest rate. I don't want to do the rate. So US 10Y gives me the 10-year yield, but it doesn't give me the. So if I do this. See, it's just the same thing. It's just straight down. And that goes all the way back to 81. So what I want to get is like the maybe US 10 M2. Maybe it'll, yeah, there's nothing. It doesn't give me any anything there. So, and I want to get back behind, like I want to go back in time, not just 5 years. So BBTLX, this is what it gives me. I don't think, but that doesn't go back. VTBLX me, maybe. No, let's do this. Vanguard. Yeah, this only goes back to 2008. Oh, let's try BND. Yeah, see, the thing is we're only going back to, we're not getting enough. I want to go back before the 2000s. So I want to get back, especially if we're talking about bonds. I want to get into the 70s for sure, because the 82 was when everything changed. Right, the index, not the rates. anyway, no, it doesn't matter because it's not that's irrelevant to me, I guess. I like, maybe this would do it. And I should be going straight down. Yeah. So same thing. It's just straight down. So all we can see is we're measuring dollars with bonds. You're kind of measuring rates against the amount of money that's out there. And so what you're getting is you're just going to get rates have gone down. And notice we don't get much before 1982. So since 1982, it's just done this straight down. So this isn't going to reveal anything to us. So let's abandon this. Dry hole here. There's nothing that's going to be as insightful as I think this one is. This one is just a lot more insightful. Every time anytime we've gone above, it's even been more like there's been more like very dramatic events in the last decade than there was in the first decade, even because this one was so big that it took years to wear off. Whereas, COVID took a month. So let me see here. So Kyle says, so if Black Swan pops up or potential quick violent move downward. So if Black Swan pops up equals, yeah. So what I'm saying here is every time we've had, now I'm not going to call the .com bubble a black swan. I will give LTCM a bit of everybody saw .com coming. That's not a black swan. Black swan is something that happens that nobody expects. LTCM, I think, was a black swan. I was, just a young chap at the time. So I was in Asia during the Asian debt crisis. So I kind of saw it, but 9/11, we knew that Al-Qaeda was, there was a jihad against the United States. So, but we did not expect that. So 9/11 was a black swan. Global financial crisis, nobody really knew that it was mortgage-backed securities that were the thing, and that the insurance companies and banks and the entire financial industry was exposed to these, and then nobody knew everybody else was exposed, that we had exposure to things that we didn't know we had exposure to. So that was more of a black swan. Again, flash crash, we had no idea that it had never happened to us. So we had no idea that it would happen. US debt downgrade, I think that was an obvious one. China commodity crisis, I think that was an obvious one. Q4 meltdown, I think that was an obvious one. COVID, I would give that more of a black swan. We knew it was happening, but nobody knew that that's what you never would have thought that back in February that what happened, I would say. So I don't want to focus on the black swaniness of the, let's go back to the R3 bull volatile and parabolic move. Now, typically the other thing that we really want to look for is a 10% move higher. Now we want to get a 10% move higher once we enter bull volatile. And the thing about it is that's not bull volatile price action, right? We've gone above it. We've entered bull volatile here or here. Here we got our 8% correction, I think. 39.65, 37. Oh, we didn't get a full. Nasdaq gave us the correction we needed, but S&P didn't. But you can kind of eyeball it at saying in and out of bull volatile, but not a pure bull volatile. This is more of a pure bull quiet. So this trade up here, even though the analog of 2009, 2010, of April, May 2010 says we have a major correction here, and then we go sideways until October. the price action isn't telling me that just yet. This isn't telling me that just yet. And then, the only thing that's given it to me is we have been in bull volatile. We are above that parabolic line, for lack of a better term. I kind of made up my version of parabolics. And then we did get above R3. So we've met a number of the conditions that would give us that. Then we look at the Russell M2, the S&P M2, the Nasdaq M2, and everything says, yeah, we're very overpriced, overvalued, especially in the small caps. And then we have the analog saying, that something black swan-y or something violent could happen. So it's a very, in my mind, it's a there's a lot of indecision. And let's go to the bull case here, which is my go-to. I am very critical, and I am willing to be bearish when it's the correct time. But I'm not going to be bearish just for bearish's sake, just, because it is an easy rabbit hole to fall down and think that, the real smart people are bearish. The bears are the smart ones, because the bulls don't know this and they don't know that. They didn't know this about this, and their PE ratio is this, and like all these other things. And it just sounds so alluring to a newer trader, a middle skill trader especially, that they get caught up in the bear case, because they don't want to. They just left being a noob, so a low skill trader. They've left that, and now they've so let's talk about the Dunn-Kruger effect. Okay, here it is. So the Dunn-Kruger effect is a great explanation of low skill trader to high skill trader. So a low skill trader, can you guys all see this, by the way? Just clear enough on the chart. Okay. So a low skill trader starts out here. They're, long, and they've learned how to do things. They've done a little bit. They've done really well. Again, my father-in-law is a low skill trader and makes a pile of money because of the fact. So you start out here, you buy stocks, you buy, the Starbucks and the ones you like, and the ones that are strong in the economy, and the ones that are winning because there's a good product. The capital markets are working. That's great. And he gets up here, and all of a sudden he learns that, oh, everybody over here is making fun of me because I'm just the, perpetually optimistic bull. Like, I just realized that, I learned about 1929. I learned about the dot-com bubble. Oh, crap, 1987. And then you start seeing the spend porn, and you're like, then you do this like middle skill trader thing. And what that is you start going, again, like, nobody wants to be the ignorant guy or girl over here. Nobody wants to be the ignorant one. And they don't realize that over here is a lot similar to this than over here is to this. This is your middle skill trader. And it starts over here, and they learn how to short sell, and they're all, it's a big time, right? And they're all bared up always, and they're constant. Every time you see a bull market, you think to yourself, oh, that's the top. Or my Uber driver was talking about trading options like that. Everybody uses those everybody who uses those sort of references that comment on Twitter saying, oh, that's the top or whatever. They're right in here. They're still very confident about their skills. but they're continuing to go down this path that they think they know what's going on. And then, and, you know, maybe down in here, you capitulate and you're like, crap. And your equity curve should look like this as well. Actually, this isn't just the chart, but you start getting down in here and all of a sudden you're done shorting. You're like, oh, well, you know, whatever, 4,200, 4,200 on S&P is, I mean, 4,400 is inevitable. So whatever, I'm done shorting and I'm going long. And that's when you get that big shakeout, because you've just capitulated to the long side. This is the vast majority of traders are in this area right here. This is where we all make the most amount of money from these people. High skill traders make the most amount of money from these people right here. And so when you go long something like, you know, 4,400 S&P or 4,200 S&P and it drops 8 points, that's when you get, or 8% or more. That's when you start getting that, like, I know nothing phase, right? Let me see. And then, you know, a lot of people typically die out here. This is where it, you know, you capitulate and you go long and the market, you know, rips your face off. You capitulate and then, you know, you try short again and it just, you know, you're just no good. You're not doing anything right. You're probably doing better over here. And then after, if you make it through that and you stop getting so caught up in the opinions and start, you know, like finding predictable, repeatable patterns or you know, ways that are mathematically advantageous, whether it's pattern recognition or anything else, then you start moving yourself into the expert phase, which is, again, I'm pretty good, but know my limitations. And so it's very difficult to you know, accept this and learn this. But it's, you know, in hindsight, it's much easier to see it. So in bull markets, markets constantly making all-time highs. Yeah, too far, too fast. I'll see. I wonder how much this trader curve has to do with expectation of income and trading instead of trying to trade both sides. Expectation of trading results are trusted. It has something to do with it. Yeah, expectations definitely have something to do with it. Yeah, it's going to take a lot longer than everybody thinks to hit the expected returns that you want. You know, like it's not today. If you know, a clear thing is if you see this and then you look at this analog and all you see is that, well, then you're going to oversize and expect you're shorting the absolute top, and you're going to be the you know, the victory lap. You're going to run around and say, I called the top, I was short here, I've nailed this and everything. But usually what ends up happening when something this obvious shows up is it just keeps ripping. And what we're seeing here in equities is we're in bull quiet. We were in bull quiet there too. We're barely above R3, which doesn't mean anything. We can go for the next, you know, 3 to 6 months. We can go a long time before we have to have a pullback, which we saw in Russell. But yeah, a lot of people, when they put on a trade, they're expecting, especially the middle skill short sellers, they're looking to get short. They're always thinking they're getting short in this setup. They're always considering this. Every trade is this trade. The other, you know, the other 250, 245 trading days of the year that don't do that, or even, you know, the other 800 days that don't do that are where high skill traders make all their money. So what we want to do is when we get to a risky area, we want to be prepared for what risk could look like and what may affect, you know, what we can do to mitigate things. And risky areas come up. You know, our best way of knowing risky areas are the parabolic moves, the bull volatile regime. We don't worry as much about it in bear quiet or in bull quiet. We have to worry about it in bull volatile. we worry about it at R3. And then we worry about it when we go parabolic. So those are the things that keep us from getting too ahead of our skis, right? So we have tools to help us to know, and what we need to know, that's where it comes back to market regimes. We just need to know what is more likely. That's one. And that's kind of important, but most important is, how do you adjust your risk management? Do you just say bull volatile's too hard? I'm gonna take bull volatiles off and I'll just trade bull quiets. That's perfectly fine. Are you looking at things saying, you know what? Yeah, I know bull volatile is going to happen, and when it does come, it's going to give me 8 or greater percent sell-offs. So I probably want to have some cash so that I can continue to allocate on ones that I think are on tickers that I think have a really good opportunity. Crypto traders do a pretty good job of that, actually. Let's see. I wonder how much triggers do with expectations. Okay, yeah. So yeah, I think I covered that, or at least my thoughts on it. Yeah, I can speak for myself here. Middle skill traders always think they can time a pullback and buy back in quicker. Yep. That's what I was getting at right here. Exactly, Dan. Middle skill traders are not, usually what happens is they're not willing to buy this dip right here. They're looking for this dip. And by the time this dip happens, they've already capitulated and got long up here. So they're like, well, you know what? We're already up. It's never going to stop. I'd rather, at least just suck it up, close my eyes and go long. And then this happens and they get stopped out. That's typically how it works. When I look back at my own life on things that I really wanted to do, worked for, even when they finally showed up in my life, it was pretty unexpected. I had mostly forgot about them. They weren't, yeah. And I do see the use in just devoting trading bring power to one side of the market, even if market is often longer. Probably should just keep my price. 300 stop trend. Okay, so I've got to head out later, Kyle. The thing about it is we will be able to figure out when a bottom, in the general location of a bottom, right? So that's what I do, right? That's what we all do. Nasdaq, for example, I missed that one, to be clear. This last one, I added my puts here because it was, it was potential there. And so I bought the put there, which just kept, and I stayed long. That kept me long, right? I started to hedge around here. And then because that's when the highest risk happened, right? When the highest risk happens, you just want to have your, when the highest risk happens, you want to have yourself positioned to have the least amount of, you want to have the least amount of pain. So, what could have happened here? When I got, it was like 12.6 or so. Let's say you get down to the COVID high, move down there. That 3,000 points, that's, that to me would have been a totally reasonable pullback. And so what I'm wanting to do is mitigate against that. I'm not worried about this. So if I go out and I spend $5 on a put that keeps this from, derailing my account, is the game plan. That's best for me. Now I stayed long. I'm still long. I haven't added to Nasdaq, since back in here. So I'm still doing okay. It's just I have half as many positions as I had because we expired worthless here, or we didn't expire worthless, but we expired the December and October buys. So those expired in here, somewhere in here. So it was a little bit of profit. But these are all very profitable. So since I think it was, let's say it's, November, December, when I was buying those. So we're still up on those. The put is there on that. And if it does happen, it happens. But so, that's a couple 100% return in 1 year, playing the long side only and just adding a put. Once, twice, taking a little bit of protective hedge And you'll notice that when it happens, typically when the big thing happens, it happens on the quarterly expiration. So June expiration here, September expiration. I guess December expiration didn't really get affected, but the March expiration. So we started to see some interesting timeframes too. So, you know, that this would suggest that the June expiration might be a little bit. Let's see, the pullbacks eventually bottom at much higher levels. So yeah, I mean, if this thing would have, let's say this would have been the top and we went into a 5-year bear market, for example. Now my put makes up a bunch of that. You know, I make up a bunch of money on the downside as these expire worthless. Now I have a nice put, and then, you know, I cover and I'm pretty much hanging out in the, I'm pretty much just hanging out with a bunch of cash in a 5-year bear market. So, you know, what do you want to do during a 5-year bear market? It's, you know, you go find the bull markets, or you find things that are you're gonna want to go shopping with. Okay. By the fear. I'm glad you mentioned that as traders, we can choose to play certain regimes like bull vol. Yeah, you can. You can absolutely just specialize in one. In fact, you know, don't mess with all of them. Get good at one and then add a second one. Least amount of pain equals lighten overall exposure. I'm not sure I understand. Can you re-ask that? Least amount of pain equal, because I don't sit and I didn't read. As the market keeps going higher, lighten up on positioning. No. I like to, so, you know, if we're in bull quiet, I like to put on the most amount of exposure. We get into bull volatile, that's when I start adding risk protection, and I start letting some of my contracts expire, whether those are futures or options. So, you know, as we continue higher, this, you know, this starts looking like bull volatile right here pretty quickly. So we, you know, let's see how things trade in this post recovery. I mean, that was what, a week or two, big move. Almost 2,000 points. Yeah, 1,000 points. 12, 8, 13. Yeah, 1,000 points. So I don't have full exposure to Nasdaq right now. I am building positions on YM right now. And I have a buy stop in place if it goes higher here. And I'll tighten it up. And I'm very, very cautious on shorting this, but yeah, I don't really have an opinion on going short. I have a buy stop in place on the high base if it breaks. And I am watching in bear market for equities, look to trade different asset classes, or you can short depending on. So if you have a good bear market strategy, you can trade a bear market strategy in equities. You can trade it. Of course you can. Yeah, I mean, just understand people are more fearful and do it, you know, bear quiet and bear volatile is way different than trading bull quiet and bull volatile. And it's not because, you know, it's the opposite. And that's just on equity indices. Currencies, bear quiet and bear volatile are very similar to bull quiet and bull volatile. And commodities also. Looking good on gold. Still liking gold, liking the euro and liking gold. All right. I think I've done enough today. You guys got any questions specific, or can we This euro just keeps doing it. Holding on. All right, Loy. Oh. Yeah, I think Grant probably got long today. I know he had a couple of orders resting to try to get in, so he's probably get long here. Nice. Sure, Dan. What's your trade on that one, Ashley? What rules do I have for trades that keep trending? Well, the Nasdaq is the example. The Nasdaq for all of 2020 and 2021 is how I do that. I look for the best sell setups to fail, and I just continue to add to the trade. And then once we get into bull volatile, I look to protect my downside. It depends on what you want to do with it, Dan. You can, if you would rather have a lazy long, okay, got it. Okay, Ashley. If you want to be a lazy long, like if you just want to kind of be long and then, you know, not worry about it and kind of go about your life, you can just, you know, do a hedge every 3 months. Just, you know, pay like 0.5% or, you know, some small, you know, 10th of a 10 basis points or something like that on the portfolio, and you know, have an outlier hedge in place so that if the world falls apart, you can, you know, have your downside protected. Now, if you're being active about it, I wait until we get to R3, above R3, till we get into bull volatile, until we start seeing a parabolic move. And at that point in time is when I start looking to, I'll add a hedge, like we're getting there right about now. I'll add a hedge. Ideally, that hedge does nothing. And I don't pay a lot for the hedge, and I want it to be far enough away that it would actually be useful. I'm not trying to make money on the hedge. I'm just trying to, like, for let's look at diamonds. So for diamonds, you know, I would look at something like, you know, below 300 maybe. So we're at 340. I would look at maybe starting to become profitable below 310. Well, I don't know what the price would be. Yes, exactly, Dan. So somewhere in here where it would be like, somewhere down here where it would be like, you know, like if it went below here, things are really bad. Like the world is falling apart. That's how I like to use hedges. I don't like to make too much money on a hedge up here unless I just, it's just the most obvious one in the world. And so the end of August, beginning of September one was really easy for me to see that it was, you know, we were at a high inflection point, and I just knew that it was going to go down. I just knew that it was gonna drop. That one I had the highest amount of conviction on, pretty much on any of my hedges that I've done for a couple of years. So that one I had the hedge up a little bit higher, but that was based on my own work. Let's see, daily R3 on Nasdaq is a bit frothy as well. Let's see. Yeah, we're right there on Nasdaq R3. That's a little like you can see it here. It happened a little bit, and then took off. And so it wasn't like a one-to-one here. That's when this one was so hard. This one was pretty hard. But because I was lucky enough to already have, get long here, here, all along the way, I was in some pretty good money. And so it kind of, I had enough cushion that I was able to buy something here. And again, had it really turned into something much worse, then I would have benefited on the downside, and that would have worked everything through. But since it didn't, that's fine. And we started messing with the diamonds. Yep. All right. So, still going to make a decision on the diamonds. Anyway, better be great trading one asset class or good trading them all. Are you asking me binary questions again, Dan? It's better to be trading one setup than two setups. It's better to be trading one ticker than it is the whole asset class. It's better to be, if you're not good at one thing, you got to get your 2 hour a month, right? If you can't get 2 hour a month, don't be working for 5 hour a month. Don't be working for anything else. You got to get good at one thing. So the best way to become good at trading is just be good at one thing. You're looking at 22 years of experience here. So I can be good at a number of things, and I don't want people to think that it's just easy to start day one and have this amount of knowledge. You can read as many books as you want, and watch as many seminars, and that will help. You can study. It will help for sure. Everything you do helps. But you got to practice. You got to do the manual back testing. You got to paper trade. You got to practice. You got to understand your risk rewards. You got to understand your exposure, and you just got to be good at one thing. If you can't be good at one thing, you can't be good at more than one thing, is the way I look at it. I know that you could like go and specialize and get and perfect isn't the way to do it, but just be good at one thing. You need to be, look, world class isn't perfect. Perfection is a fallacy, in my opinion. I don't know if you've read the book, and I highly recommend to everybody who wants a really good book to read. Growth Mindset by Dr. Carol Dweck is incredible. And it's about a growth mindset versus a fixed mindset, where a growth mindset sees in a mistake, sees an opportunity to learn. In a fixed mindset, you call yourself a loser when you made a mistake, right? So perfection is not what you're aiming for. It's continual improvement. Better to improve than anything like that. So yeah, highly recommend Dr. Carol Dweck's book, the growth mindset. That will, if you can figure out how to apply the growth mindset to the way you do things, you're constantly improving. So a fixed mindset person would take a test that they knew that they were going to ace. They're not going to take a test that they're going to make a mistake on, because they're worried that people are going to think that they're not as good as they are, right? So, well, if you're the so good as you say you are, why are you why didn't you get 100% on this test? And a growth mindset person takes a test to see where they can improve. Where are my weaknesses? Where are my strengths? So that is probably one of the most helpful ways to see things in this. And instead of knowing the answer, putting together the hypothesis to get proven right or wrong moves you a step forward. All right, guys, that's it. You got it all. Later, everybody.